Welcome to Counsel Culture, the Business of Law podcast from Byfield. I'm Lindsay Goldthorpe, Associate Director at the agency, and I'm joined by Ben Girdleston, Joint Managing Director. We are recording this midweek. Ben, how's your week going so far?
It's pretty good, actually, Lindsay.
Yeah.
As you know, I've been a bit under the weather, like half the population for the last couple of weeks, but today I'm starting to feel a lot better. So I am happy to see you and happy to be here.
Good, great. Well, we've got lots to get through. It's been a really, really busy news agenda generally, I think, but there's been some pretty big stories that we've spotted. So why don't we jump right in? First up, there is reportedly McDermott Schulte is exploring a private equity tie-up. Now, this has obviously been massive news, if true and confirmed, given the ownership and governance laws in the US. Were this to be true, it would have massive implications for the industry. Ben, what are your thoughts on this?
Yeah, so the story is this, that just overnight, it broke from the US that McDermott Will Schulte, the newly combined firm, are looking to restructure themselves to allow it to sell a stake of the business to private equity groups. And without getting too nerdy, there is obviously an important differentiation between ownership rules in the US and here. Here, there's obviously been a huge amount of talk of private equity and investment in law firms. So it's much easier because you can be whoever you want to be and own a law firm or a bit of a law firm. Whereas in the US, the rules are they used to be here, where non-lawyers cannot own law firms. It has to be lawyers. So if you are a private equity group or a litigation fund or whoever, and you're looking to invest in a law firm in the States, you've got to be very creative with the partners. And the theory is this, that without, again, getting too technical and sending people to sleep, that it is quite important that a firm such as McDermott that wanted to attract investment would have to break itself pretty much down the middle between the fee earners and the lawyers and the non-lawyers, and private equity can invest in the non-legal bit. And then you ask yourself, well, how does that make any money? And then what happens is that the non-legal side, which is everybody from secretarial to business development to finance to technology, etc., sells their services to the legal bit. The lawyers. The lawyers literally pay for the services that they get, and the private equity firm takes the profits from those transactions. So it is quite convoluted, but the fact that McDermott have come out and either off the record or somehow let it be known that they're open to this is massively significant. I think they are a huge firm, and it will be, if this happens in the foreseeable future, the near future, I think it will really open the floodgates. And, we talk every week about, investment into law firms, and boy, this is a big story. It's a really, really big story. And it's really just breaking as we record. And it'll be interesting to see how the mainstream legal press follow it, and their analysis and their take. So I think it's probably, even though it's just breaking, it's absolutely right. I think that we've led off with that.
Yeah, and we'll continue to follow it. I suppose one of the interesting points that I picked up from the FT's reporting today was when we've been speaking about private equity investment into law firms in the UK, it's been very much tied to technological advancement, AI in particular. I think you and I had discussed the chief information officers and the innovation angle that this investment brings. With McDermott in particular, given it is one of the largest law firms, do you have a sense of what this investment would be buying? Is it brand? Is it the business? What are your thoughts?
Fees, I think.
Yeah.
Because you're absolutely right. If you look at some of the narrative around private equity investment into law firms in Europe, it's all about, exactly as you see, the need of smaller firms to finance AI and related tech. And, they want the investment to be able to do that. I mean, I could be wrong, but I don't think McDermott are short of a few quid to buy products. So it's probably not that clear but surely it must be the levels of fees that they are able to attract for work, the ability to cross sell, etc. And private equity want a bit of that. There may still be the tech angle. I don't know McDermott well enough to comment, but some of these big US firms, if you're a private equity investor, I don't think you're just going to be investing in it so the partner's got enough spare change to buy some kit. I think it must be around. I think it must be around the fees that they're able to generate on big transactions and big matters and class actions and things like that.
Okay, well, I think we'll all be watching closely to see how this one unfolds. Another story that we wanted to have a chat about this week was Brad Karp's comments at the New York Bar Foundation event, where he talked through the events over the past months, both from a kind of personal perspective and the firm's strategy around the pro bono decision. Needless to say, is the comments weren't particularly well received by some employees in the room, pointing obviously to the fact that, when you are addressing, I think the issue is still very prevalent in a lot of people's minds. I think we were, here in the UK, is it fair to say that the issue is dying down somewhat?
Yeah, we've talked about this before in terms of the whole Trump ripple effect, etc., etc. It's almost a non-story here now. It feels like it's done, but it tells you very much that it's not done in the States, and it's still very raw and very tricky for firms that have cut deals. And it's certainly fair to say that Brad and his firm have got, if you break the flag into 100%, they must have got 80% of it from the reputation perspective. I don't think that's necessarily very fair. I think that it still feels very, very raw, doesn't it, on the other side of the Atlantic. And for those of us who think, maybe it's all kind of blowing away and the reputational side is done, it's not the case. One of the sort of best things I've seen around this is former Ashurst senior partner Charlie Geffin wrote a letter to the FT some time ago, basically saying, look, these firms had to cut deals. They wouldn't have been able to exist otherwise. And it's a really good argument, I thought. And he talks about it again on the latest Non-Billable podcast, or one of the recent ones. And it's a good listen. It's worth listening to. But I think that tells you that the emotion around what people expect from their places of work has not gone, whereas some of us thought it may have done, around this. The vocal associate base that we saw at Skadden, for example, you kind of thought, well, maybe it'll die down and the next thing will be focused on it. It tells you that it hasn't. So the reputational damage of what happened in April, May, June this year is yet to be felt fully.
Yeah, it's a really interesting one. And I think important, as you say, that leaders continue to understand that this is a very emotive and personal issue for employees, and it's not one that is going to be solved overnight. So continuing to have these conversations, I think it's going to be a really, really important part of the journey. And I think as we see it rumble on in the States for probably some time yet. Another interesting piece that we saw this week was some interesting analysis by the lawyer into the number of FTSE 100 GCs from law firms. And it has singled out Hogan Lovells specifically for having 8 GCs in FTSE 100. Ben, I know you love digging into the data into this. What do you think of the piece and the trend overall? Because it was I found it really interesting.
I like things like this. I think because I come from obviously a firm of Salter May, who are second in that list, who seem to be pretty much cornering the market in terms of working for the FTSE 100. And what strikes me is this, and there's a couple of details which are not quite in there, which I would love to have seen. It is surprising that Hogan Lovells have that many kind of alumni in GC hot seats. But I think what would really fascinate me would be almost a map. If you were to list the each of the FTSE GCs, have a look at where they started their careers, whether it was Hogan Lovells, Saltram Mail, or wherever else, and look at the firms they instruct. Because the thinking always is, when you're a law firm, that if a talented associate leaves you and goes in-house, you sort of think, okay, you've lost somebody good, but actually they'll probably give us work at some point in the future. So it's probably a bit of a win-win, really. But is that really the case? I would really be interested in seeing that. Secondly, the list is not exhaustive, and I would be interested to see how many, or if any, of the FTSE GCs actually never worked in private practice at all and had another route in, or they started off in-house. That also would be interesting. I mean, is it a prerequisite of being a GC that you started off in private practice or not? I don't know the answer to that, and I would like to know. But it was a good piece of analysis in the lawyer. I like the way they do these things. I think they took them from the advisor rankings, didn't they? Which kind of come out fairly frequently, which are always rather under the radar. But for sort of facts nerds, they're good sources of info.
Right, more of the same, please, then from the lawyer team. Now, as we look ahead to the budget in a couple of weeks' time, it seems like there is a story every single day. Tax teams are certainly gearing up to have a busy day, certainly from the comms side of things. Now, one story that we have been following really, really closely was the potential rumblings that law firms were going to be faced with employer national insurance taxes, so taxes on the LLP partner profits. It seems now there's been a bit of a flip-flop, and actually that has either been scaled back or is not going to happen at all. Now, I think the amount of news coming out of the government it's been pretty unprecedented over the past few weeks. Ben, what's your view on this one?
Well, at Byfield, we are absolutely apolitical. It's not our place to have political views. And on a personal level, I don't think anyone's particularly interested in mine. However, from a comms perspective, talk about a model. As we were recording, Keir Starmer is apparently facing a leadership challenge from West Streeting and is sort of defending him at PMQs. This story has gone up in severity and down in severity. You had Rachel Reeves making that extraordinary speech, I think was at the weekend, about what may come and what might not come in. It's really modelled what might be in the budget. However, it's quite serious, this, because if it is the case that LLPs are going to be taxed in a major way, law firms have got two choices: pay the tax, which is significant, or the partners, but B, try and do some restructuring to mitigate some of the risk and the tax liability, which is a complete load of work, and it's just not that great, I don't think, from an optics perspective, for the government to be taxing actually one of our finest industries, which is legal services, any more than any other. So, not going back on my apolitical point of view, but I think from a comms perspective and an actual perspective, it doesn't really feel that great. And I would hope that some of the worst fears don't come to pass, but we'll have to see.
Well, I'm sure we'll all be tuning in, and we can have another catch up once the news is out. Thank you. You've been listening to Cancel Culture, the Business of Law podcast from Byfield. Thanks for listening, and we will see you again soon.
You've been listening to Cancel Culture, the Business of Law podcast brought to you by Byfield. Thanks for listening. Don't forget to subscribe and join us again next week, where we'll be discussing some more of the biggest stories in the legal sector.